In this video I'm going to demonstrate three possible variations of the generic break-even function. One of the things that we can do is calculate a desired profit, not just the break-even point. Another thing that could be done is to calculate desired profit but on an after-tax basis. And a third possibility is to calculate break-even point whenever you are in a scenario where there's multiple products. So here's the basic break-even function: total fixed costs divided by contribution margin per unit. And if we would like to calculate how many units we need to sell to earn a desired profit, the only modification that we need to do to the formula is just to add that to the numerator. So here's total fixed cost, contribution margin per unit at the bottom, the denominator, and all we do is add the desired profit that we would like. This gives us a formula as such, and you must take into consideration that this desired profit that you're computing is on a before tax basis. So for that reason I designate this as PBT, profit before tax, which is the same thing as this. Many times what we need is not a before tax profit, but instead an after tax profit. So we can restate PBT on an after-tax basis and just come up with this particular function here to come up with the number of units you need to sell to generate a profit after tax. So how do we go about that? Well, the easiest thing is just to think about what profit after tax is. Profit after tax is nothing more than profit before tax minus the tax. From there we can specify here that what is the tax? Well, the tax is the profit before tax times whatever tax rate we're talking about. So now that we have this expression, we can simplify it by factoring out the PBT. So if you factor out PBT from here and you factor out PBT from here, you're left with PBT times 1 minus the tax rate. And we need to express this in terms of PBT. So if we're multiplying 1 minus tax rate over here, we'll divide it to bring it to the other side, and that's what we're observing right here. Profit after tax divided by 1 minus the tax rate equals PBT. Now that I have something, now that I have profit after tax expressed in PBT, I can just put it back into the original formula. And then that formula is going to look like this. So you have total fixed cost plus profit after tax divided by y minus TR. And you got to be real careful with the parentheses here as to what needs to be done in terms of the calculation. And then finally, our third possibility is a scenario in which you have more than one product line. And it's basically the same formula as the original one, total fixed cost divided by contribution margin per unit, except that the contribution margin per unit is weighted. So this WA means weighted average, the weighted average contribution margin of a multiple product setting. So assume that there's 3 products that we sell, and each product has this contribution margin attached to it. So A generates $300, B generates $700, and C generates $1,000. And here I provide information on the market share of each product. And this is a big assumption that we must come up with in terms of being able to do this. Then once we have the percentage market share, we weigh those contribution margins. So 300 times 30% is 90. That's the weighted average contribution margin for A. 350 for B, and 200 for C. We sum those up, and the weighted average contribution margin is 640. So if we assume that this company has fixed costs of $1,080,000,000 and divided by that weighted average contribution margin, break-even analysis says that we must sell 1.7 million items. And this is the total number of items you need to sell. So then you have to split it up in their corresponding percentages. So 30% of this is 506,000 of A, 843,000 of B, and 338,000 of C.